Welcome, everybody, to the SNN.Network Canada virtual event. I'm your host, Robert Kraft, and thank you for joining us today. I'd like to introduce our next speaker. It's a keynote presentation from Dave Barr. It says David. I call him Dave, but David Barr, President and Portfolio Manager at PenderFund Capital Management. As you can see, he's doing a presentation on Pender's approach to microcap investing, looking for multi-baggers. With that, Dave, take it away, my friend.
Thanks, Robert. I'm pretty sure my mom is the only one who still calls me David, as my daughter pointed out over the holidays. Thanks, everyone, for joining me. Today, I want to talk about a big part of our microcap investment strategy, and that's looking for multi-baggers. There's a lot of commentary out there in the world on finding compounders, stocks that go up 10, 20, 100-fold over several years. And I think, we go looking for these things, and we know it is possible to find them. And this is really, as a microcap investor, an individual investor, where you can generate outsized returns for your portfolios. So who am I? Who's Pender? We started in 2003. We were initially focused in the venture market. In 2009, we expanded into public markets. We took our expertise in investing in emerging growth tech companies and started applying that in the public markets. Today, we manage a suite of niche funds, focus on inefficient parts of the market, microcap being one of the major ones, what I love to do. And, we run concentrated portfolios, and we always pay attention to the price we pay. Firms owned by employees, we all love to invest, and we invest alongside our clients. Today, we're looking for the proverbial needle in a haystack, the search for 100-baggers. Stocks that go up 100-fold over a long period of time. It's great if they go up over a short period of time. Probably lies more on the speculation side than the investment side, though. So is it actually possible in today's market? And several years ago, I read a book called 100 to 1 in the Stock Market by Thomas Phelps. Book was published, I think, in 1972. It was out of print for an incredibly long period of time. But he studied over 365 stocks that went up 100 to 1 from 1932 to 1971. And what's really interesting is in each of 32 years, you could have bought one. So every year there was something to do. But like a lot of people say, like, oh, those are the good old days of investing and markets were inefficient and you had to wait until the financial statements showed up at your door in the mail if you're lucky. Can you actually do this today? And I look at the Canadian universe. As Constellation's up 97-fold from where it was trading near its trough around the IPO. Enghouse from its trough is up 52 times. Little known company, closed-end fund or closed holding company we manage, Pender Growth Fund, ticker PTF, is up 218-fold. So absolutely, you can still do it today. Interesting point on Constellation. I think I gave this presentation about 3 years ago, or a similar version of it. And initially, at that point in time, Constellation was up 32 times. Pretty sure everybody in the crowd would have said missed it. So you only missed the 3-bagger since then. So, I certainly did. The updating Phelps, Chris Mayer, he updated the book in 2018. Very similar findings, but expanded the time horizon. He seemed to focus more on growth companies. There's a couple different opportunity sets that Phelps identified, and I'll go into that. But Mayer is really focused on growth companies. And in particular, one of the things he talked about was there's a paper written about the coffee can portfolio. And it's really like sitting on, when you buy these things, just sit on them for a long period of time. If you want to hear more, I had a good conversation with Chris on our episode 55 of a Pender podcast, and that was released on November 12th. But great follow-up to Phelps's book, and just really reiterates that it still is possible and gives a lot of great examples. Probably the companies are a bit more relevant because he does talk about companies that are around today. So where can multi-baggers be found? This is Phelps' original book. It really focused on a couple things. The two areas were smaller companies that experienced a ton of growth, and also restructurings. So debt restructurings, corporate restructurings, people buying discounted debt, rolling it into the equity and then riding the lift on that. Second, and what I really focus on is companies that are unfollowed, just too small for the big institutional crowd. And this remains, and I think actually is becoming a larger advantage for small funds or individual investors. As more fund companies chase scale, managing multi-billion dollars. If you just do the math on a $2 billion fund, a 2% weighting is $40 million. So you're not buying a $50 million company, you're owning it if you're trying to go there. And because of restrictions, it's just not possible. You can also look in the too hard piles. There's a lot of places out there people just don't want to look at. Complexity through bankruptcy and things like that. General market downturns, I think, here we are, 10 years after the financial crisis, had a serious downturn in March. I mean, it was crazy volatility, massive drawdowns. Turned out if you entered the right positions back then, it was a great entry point as of today. And then general industry downturns, when an industry is out of favor, that's usually, when you'll find things just get flushed out and available at the right price. So what do you need to look for? I mean, start small. In order to go from a small company to a really big company to compound 100 times, if you start off smaller, you're stacking the odds in your favor. And when you're looking at these smaller companies, you really need to focus on companies that have a truly differentiated product or a service. They delight their customers. They're just doing something that people want to buy the products. And hopefully they'll be able to protect that and have people buy their products for a really long period of time. Third key aspect is you need a large target market. So the company needs the ability to grow within its market. There's some exceptions to this. I mean, you can expand your market through acquisition, going into other verticals and whatnot. But you need to be looking at companies that have a long runway ahead of them. And finally, if the captain of the ship is going to take you into the rocks and sink the ship, there's no point getting on board. You really need a proven long-term focused management team. A management team that is experienced in operating profitably, making sensible, focused investments as the company scales up and understands their business deeply, has a much higher probability of executing on that big available market than a less worthy management team. So know who's running your investment. So as an investor, what are some of the things you need to be doing to capitalize on 100 baggers? First of all, you need to be a contrarian. I mean, you need to be looking at something that does, if you're on Twitter, people aren't going to feel good about it with you. If everyone congratulates you on a great trade the minute you do it, and a great investment the day you do it, you're probably not setting yourself up for a high probability of success. The second aspect is having a really long-term outlook. Compounders, it doesn't happen in a day, it doesn't happen in a week. It happens over decades. It happens over really extended long periods of time. And the magic really happens in the later stages. I mentioned Constellation software company, as Canadians, most of us all probably know really well. I mean, 3 years ago, it was a 32 bagger, and today it's almost a 100 bagger. So, if you didn't hold on for the long term, just the 3x in the last couple of years has taken it from 30 to 90. You really have to have that long-term outlook to let the compounding really take advantage. One of the key lessons from Phelps's book, and talking to Chris, we talked about this quite extensively, and you really have to, as long as your value proposition, your thesis is intact, and earnings are increasing, you want to hold the position. And this can be really challenging because when you look at things with a value lens, the price you pay is very important, so you're very focused on price, so that if it reaches what you think is potentially fair value, there's always the impetus to do something. And but really, when a business is working, when it's growing, when it's compounding its internal capital, you just got to let the business do its part in generating your returns. And as easy as that comes off my tongue, it's a lot harder to do. On the flip side is you always need to be managing risk and always testing your hypothesis. So you do need to know if your hypothesis or thesis for owning an investment and the opportunity is presented with, if it's still intact. And I just think what we went through in March and April was, our entire team, we sat back and we basically re-underwrote every single opportunity. And is our investment thesis still intact? If it's not, okay, we need to probably move on. But always testing that to make sure that the assumptions that you're making still hold. So, how do we do that with part of our investment process? I always like to say we take a private equity approach to public markets, and we overlay that with a value-based investment strategy. Value has a lot of connotations. For us, value is really just paying less than what we think a security or a company is worth. The private equity approach, here's another great author, Phil Fisher, wrote about common stocks, uncommon profits. And really what he coined it his scuttlebutt research and due diligence. And coming from the venture space and originally reading this book, I think it was in 2001, 2002, I read the book and I was like, oh my goodness, he's doing exactly what we're doing in the private space, but in public markets. And really drilling in and understanding the business, the industry it operates in, talking to the customers of the company, the people at the company, understanding the competitive landscape, really knowing that business. And because knowing a business incredibly well gives you much better insight into what that business is worth, what the risk factors are, and what the opportunities may be for growing the value of that investment. The second part of our the private equity approach that we really apply to what we do today is having sat on boards of several companies over the past 2 decades. You work with management teams and you see those that make really good decisions. Conversely, you see management teams that make bad decisions and do silly things. So, having that lens where you've seen management teams and CEOs and boards make decisions in real time really helps us, I guess, weigh our jockey bets more appropriately. So just being able to understand the management teams you want to support. The flip side of that is it also gives you some insight into when companies are reporting what they're really saying. So if you've been in the boardroom when financials are being presented and talked about, and then how they're talked about outside the company, it gives you a bit more of a filter to understand what's really going on underneath the hood. The third part of private equity is, when you're dealing in the private world, up until recently, liquidity events were all through M&A. So really, you do deep due diligence. Takes you a while. When you get conviction, you buy something. You work with the company to create value over time, and then to return capital to the unit holders in your funds, you go out and monetize the investment. Looks like there's a pretty nice IPO market right now, so probably a lot of people pursuing that. Historically, it's been been through the M&A market, and having worked with companies through an M&A process, both on the buy and sell side, it gives us a lot of insight into the types of companies that are bought and sold, what buyers are looking for, what buyers are willing to pay. So when you overlay that, it's when you're looking for 100 baggers, usually a company being acquired is a bad thing because it short circuits the compounding process or transfers it to somebody else. But in a general investment perspective, it gives you insight into what a company's worth at any point in time to a third-party buyer. So the second part of it is just overlaying it with a value lens. And this is for us just trying to figure out what the security we're looking at or the company we're looking at is worth, and making sure we're getting it at a decent risk-adjusted price. Compounders will be less of a discount. A broken down sawmill in northern BC, probably demand a much higher discount to buying something of that nature. So we've over the years we've come across a couple interesting data points. So we try to refine our process and identify parts of the market where we've got a higher probability of outperforming and generating great returns. I wanted to share some things with you here. There's a great quote by George Baker. To make money in stocks, you must have the vision to see them, the courage to buy them, and the patience to hold them. And I think once you've been at this for a while, the hardest part can very much be the patience to hold them. And that's one of the big if there's takeaway from what I'm saying today, it's there's a big never sell movement out there on Twitter. I wouldn't say never sell, but you do have to hold your compounders for the long term. This is from an interesting study put together by Black Star Funds back in 2008, I think it was. But it analyzed all the stocks that went to the Russell 3000 between 1983 and 2007. And what it shows is, basically 75% of all stocks collectively had a total return of zero. So 3/4 of the market, you put your money in, you're not going anywhere. But 25% of stocks accounted for all the gains. And if we present this a different way, if you look at this on the right-hand side, 20% of companies returned 300% or better. So those are the compounders. Those are the businesses you want to be invested in over the long term. For us at Pender, what we see is, and you got the middle kind of 60% there, where companies are actually creating value. But this is much more traditional value investing, where you need to make sure you pay a great price for these things. And when the discount closes and you get close to intrinsic, you move on, because those types of businesses tend to round trip quite a bit. And then, most importantly, particularly in the microcap space, is the left-hand side. So, 20% of stocks you're going to go to zero on. I've been watching a lot of the IPO market recently. I think there's probably a lot of stuff that could be going to zero. There's a lot of stuff that will be going up quite a bit, but when you really have to be careful with zero revenue concept stocks, stocks that are perpetually raising capital to meet working capital needs with no visibility towards sustainability. And then the straight up frauds. Those are the things that go to zero. But then 40% of stocks you're going to lose money on. So in the microcap space, if you're buying a higher quality business at a good price, you're probably setting yourself up for the right side of the graph here as opposed to the left side. But the predominant, a lot of the companies that have gone zero are, the concept businesses or the over-levered balance sheet businesses. So that's where you really have to, have a really high filter and bar, avoiding those types of companies in the microcap space. Another point, if you look at size of a company, the larger a company is, the harder it becomes. If you look at this chart here, from 1972 to 2016, the S&P 500, $1 became 66. But if you bought the largest market cap company in the S&P 500 every single year, your $1 became $5. So, really, you need to be focused on, in order to get the outsized returns, smaller gives you a much higher probability of achieving success. So we're Buffett fans, we're Ben Graham fans. We read a lot about all the different value investors, but what's really interesting about Ben Graham, people will attribute security analysis and intelligent investor as the Bible for value investors. And everyone thinks, it was all about book value and buying at a discount to book value. But, there's a little known secret about Ben Graham. And it's actually, he made one decision which made more money than hundreds of little decisions. And, this is like the postscript to the 1972 edition of The Intelligent Investor. And as he says, ironically enough, the aggregate profits accruing from this single investment decision far exceeded the sum of all the others, realized through 20 years of wide-ranging operations in the partner's specialized fields, involving much investigation, endless pondering, and countless individual decisions. So with everything he talked about over the years, he made more money on one investment than everything else combined, which we find pretty incredible. And what was that? Well, the stock was Geico. Anyone who follows Berkshire today probably knows Geico well. But here you look at Graham's performance over time, and the S&P 500 from 36 to 56, $1 became $15. I think that's about a 14% rate of return. The Graham Newman partnership over the same period of time would have returned 23. I think it was about 17%. And then the period 1948 to 1972 was actually even more interesting, where the S&P 500 $1 became 23, but Geico $1 became $600. So it really showed how it skewed everything within Graham's portfolio. So the real gains and the real legacy were built off of finding one great compounder. When we talk about compounders, I mean, Graham had some wonderful rules, and I think they're important to stay consistent with. But there's also, he broke his own rules, and you need to stay value focused, but do not interrupt the compounding process. So where Graham stayed consistent with Geico, he remained value focused. He was always concerned about the entry point. He wanted to make sure he got a good deal. Second, he bought a small cap stock. I think that's where the opportunities lie and a lot of the inefficiencies. But where Graham broke his rules with Geico is he made a really concentrated bet. It was a large part of his portfolio. And second, he was extremely patient. Even when it started to exceed what he thought intrinsic value was, he let it run. And so I think it's kind of a good breakdown of what worked and what didn't and how it related to Geico. But the small microcap space, it's not easy out there. J. Paul Getty's secrets to success. It's rise early, work hard, strike oil. Luck plays a big part in it. But if you're focused on the right parts of the market, particularly microcap, you're focused on good businesses with good products and services that their customers need. If they got big runways ahead of them, if they're profitable, and if they're run by good management teams, you're really stacking the odds in your favor and probably increasing your probability of getting lucky. So that's my update on the microcap space, where we could potentially find some hunter baggers. We're out there looking right now. There's always lots to do, and looking forward to a lot of the companies coming out over the next couple of days. I think there's probably more than one here this week. So thank you.
All right, Dave, thank you so much. I had one quick follow-up, if I may, because we got a couple extra minutes here. Why for you are you focused specifically on Canadian microcaps? Do you look at the US, or was that something that you just, when you first got your start, I saw Canadian microcaps, I just went from there?
Yeah, we do a little bit on the US microcap side. It's, for us, you need to do deep due diligence on the companies you're investing in, and the management teams play a really big part of it. So for us, it's easier for us to get access to Canadian management teams, just to get to the comfort level we need, because when we're taking a position in some of these smaller companies, it's being patient is easy, because when you're in for the long haul. So you really need to get comfortable with the management team. The other aspect of it is the structure of the Canadian markets. We just see more opportunities in the Canadian marketplace, given for a company to be public in Canada is way less costly than it is in the US. It seems to be more accepted here. We've got a very rich tradition in the junior public markets, particularly for originally through the resource industry and all the financings that have gone on. But people are very comfortable in the space. There's high quality companies. We'll see companies go public a little earlier up in Canada than you would in the US. So I just think it's twofold. It's give us the ability to do due diligence, but it's also the opportunity set in Canada.
Very good. All right, before I let you go, I can't let you out of here without you give us one story. Give us an anecdote of an investing experience that changed your life. In maybe a couple minutes or less, if you got one, or if you care to share one.
Well, I mean, the
this doesn't have to be like a big winner or anything, but something that you learned the most from, but something that was life-changing for you.
Yeah, well, you always forget the winners and you dwell on the losers, right? So it's no, I mean the exciting part for me was the transition from private to public markets. And there's a Canadian microcap called Gemcom Software, and it's a great little software company. They built mine planning management solutions. The company was growing at 20% year over year, was spitting out $1 million of profit, had like $4 million of cash in the bank, and was trading at like a $4 million market cap. I think it was just trading at like 4 times free cash flow. And I was looking at that, and then we had people coming into our office, and I was like, little red-haired kids with their next great business idea, and they half-baked business plan, and they thought their company was worth $100 million. And I was like, well, this doesn't make sense. Like, these guys are already doing it. So that was probably the biggest influence for me. The other time is all the times I've been lied to. I like keeping that checklist handy.
Fair enough. We'll save that one for our long form interview.
That one requires a beer.
Yeah, that one, we'll save that one for a happy hour. But Dave, with that, thank you so much for doing this keynote today. I really do appreciate it. Let the audience know where they can find more information on you and also follow you on Twitter.
Yeah, we're at www.PenderFund.com. I'm pretty active on Twitter, so at PenderDave. Love hearing from people. And if anyone has any great microcap ideas, I mean, I'm always looking. And some of the people I talk to, I've met from events like this, and private investors, hedge fund managers, microcap investors. I always like to share ideas.
Oh, and also give a plug for your podcast. You just did a great interview with Ian Castle that it was phenomenal. So plug your podcast as well. Yeah,
we've had feel very lucky. I mean, I had Ian Castle on there, and I think we went for an hour and a half, and we could have just kept on talking microcaps the entire time.
Oh, yeah.
And he's fantastic. And we had Chris Mayer on there. Couple other people. We had Bill Wignall from Sangoma, who I know has been at your conference a couple times. So It's kind of like to chat both microcaps, but then also talk to the people who are running the microcap companies we love so much.
Very cool. And real quick disclosure on the story that you told, I think you said Gemcore. Are you still a shareholder in that or no?
No, it was taken out at like $3.25.
Nice.
Trading at about 12 cents when I first figured it out.
Nice. All right, Dave.
We're in the compounding process, though.
I like it. Well, Dave, thanks again, man. Really appreciate it. And we'll talk again soon.
Thanks, Robert. Thanks, everybody.